Have you ever stopped to think about what could quietly go wrong after you invest, even when everything looks perfect on the surface? That's the uncomfortable truth most people never hear before putting their money at risk. Markets don't usually hurt investors because of obvious dangers. They hurt them because of hidden ones that feel invisible until it's too late. In this video, we're going to unpack a risk almost no one talks about openly, yet it has wiped out portfolios across stocks, crypto, real estate, and even so-called safe assets. This isn't about fear or pessimism. It's about awareness. By the end, you'll see investing through a sharper lens and understand why ignoring this one factor can silently undo even the smartest-looking decisions. The risk that hides behind good research. Most people believe solid research protects them from losses, but research alone can actually create blind spots. When you study a project deeply, confidence grows, and confidence can weaken caution. Investors begin trusting their analysis more than market reality. That's where the hidden risk appears. No matter how strong the fundamentals look, markets can behave irrationally for long periods. Data explains why something should work, not when it will. When investors rely too heavily on their research, they often ignore warning signs like declining liquidity or shifting sentiment. The risk isn't lack of knowledge, it's attachment. Once you emotionally commit to your analysis, you may hesitate to exit when conditions change. That delay turns manageable losses into painful ones. Overexposure feels logical until it isn't. Overexposure rarely feels reckless in the moment. It feels logical. You believe in an asset, you've studied it, and increasing your position seems efficient. But concentration quietly multiplies risk. When too much capital is tied to one idea, even small market shifts cause outsized damage. Investors often underestimate how quickly conditions can change. What felt stable yesterday can become volatile overnight. The hidden danger is not the asset, it's how much of your financial future depends on it. Diversification exists to protect against uncertainty, not ignorance. Overexposure removes that protection. When things go wrong, options disappear fast. Many investors don't lose because they chose badly. They lose because they chose too much of one thing. Liquidity is often ignored until you need it. Liquidity is one of the least discussed risks, yet it's one of the most damaging. An investment may look profitable on paper, but if you can't exit easily, paper gains mean nothing. During calm markets, liquidity feels unlimited. During stress, it vanishes. Buyers disappear, spreads widen, and prices fall faster than expected. Investors usually don't plan for this because liquidity feels abstract until it isn't. The hidden risk here is assuming you'll always be able to sell at a fair price. History shows that during turbulence, exits become crowded and painful. Smart investors don't just ask, "Will this grow?" They ask, "How easily can I get out if I'm wrong?" Timing risk is bigger than most admit. Even strong investments can cause losses if timing is misjudged. Timing risk doesn't mean predicting tops or bottoms. It means understanding when capital is vulnerable. Investing near market peaks feels safe because confidence is high and volatility is low. That's exactly when downside risk is greatest. Conversely, fear-heavy markets often offer better long-term opportunities. The hidden danger is entering based on excitement rather than conditions. Timing risk compounds when combined with overexposure. A good idea entered at the wrong moment can underperform for years, draining patience and confidence. Investors often exit too late because they underestimated how timing affects returns. Success isn't just about what you buy, it's about when and under what conditions you buy it. Artificial intelligence can amplify mistakes. Artificial intelligence tools promise clarity, speed, and better decision-making, but they introduce a subtle risk of overconfidence. When models show strong probabilities, investors may assume uncertainty has been removed. It hasn't. Artificial intelligence works on historical patterns, not future surprises. Black swan events, regulatory shifts, and emotional market reactions can't be fully modeled. The danger appears when investors override judgment because the system confirms it. Tools should support discipline, not replace it. When artificial intelligence outputs are treated as certainty, risk boundaries weaken. The result isn't smarter investing, it's faster mistakes. Technology magnifies both good and bad decisions. Without strict risk controls, artificial intelligence doesn't protect capital, it accelerates exposure. Emotional attachment is a financial threat. Emotions don't announce themselves loudly in investing. They slip in quietly. Pride, hope, and identity often attach to investments over time. Once that happens, objectivity fades. Investors begin defending positions instead of evaluating them. Losses feel personal, not strategic. This emotional bond is a hidden risk because it delays action. Instead of cutting losses early, people wait for validation. Markets don't care about conviction. They respond to supply, demand, and sentiment. Emotional attachment clouds judgment exactly when clarity is needed most. Many portfolios collapse not because investors lacked intelligence, but because they couldn't detach. Discipline means being willing to walk away from ideas, no matter how much belief is invested in them. Volatility is not the real danger. Reaction is volatility itself doesn't destroy portfolios. Poor reactions to volatility do. Sharp price movements trigger fear or greed, pushing investors to act. Impulsively, selling at the bottom or buying near peaks often feels emotionally justified in the moment. The hidden risk lies in reactive behavior during stress. Markets are designed to test patience. Investors who lack predefined rules respond emotionally instead of strategically. Volatility becomes a weapon against them. Those who survive treat volatility as information, not a command. The danger isn't movement, it's unplanned responses. Preparing for volatility before it occurs is what separates controlled losses from catastrophic ones. Without that preparation, even rational investors can make irrational decisions under pressure. Risk compounds when plans are vague. A vague plan is one of the most underestimated risks in investing. Knowing what to buy isn't enough. You must know when to exit, when to reduce exposure, and when to do nothing. Without specific rules, decisions are made emotionally. Vague plans adapt poorly to stress. Investors delay exits, rationalize losses, or chase rebounds blindly. The hidden danger isn't market movement, it's indecision. Clear plans reduce emotional involvement and speed up rational action. Markets move quickly, but hesitation moves faster against you. A strong plan doesn't predict outcomes, it defines responses. Investors with structure survive volatility. Those without it become reactive, participants in their own losses. Survival matters more than winning. Many investors focus on winning trades instead of surviving long enough for good ones to matter. This mindset is a hidden risk because it prioritizes short-term success over long-term stability. Markets reward consistency, not heroics. Losing too much too fast removes future opportunity. Survival protects optionality, the ability to act again. Every major investor's success story is built on avoiding permanent damage. Missing opportunities is recoverable. Losing capital is harder to fix. Survival-focused investors limit downside first and upside second. This approach feels slow, but it's powerful. Those who chase wins often disappear quietly. Those who protect survival stay present long enough to benefit when conditions eventually align in their favor. The risk you don't measure. Controls. Unmeasured risk is unmanaged risk. Investors often track returns obsessively but ignore drawdowns, liquidity limits, or emotional tolerance. These blind spots grow silently. When stress hits, reactions feel overwhelming because risk was never defined. Measuring risk doesn't remove it, it clarifies it. Once risk is understood, decisions become deliberate instead of reactive. The hidden danger lies in assumptions. Assuming you can tolerate losses, exit easily, or stay calm under pressure often proves false. Markets expose untested assumptions ruthlessly. Measuring risk before investing is an act of self-awareness. Those who skip this step surrender control without realizing it. In investing, what you fail to measure eventually decides outcomes for you. The hidden risk we've uncovered isn't about one market or one asset. It's about how easily danger hides behind confidence, comfort, and familiarity. Smart investing isn't about eliminating risk. It's about understanding it before it understands you. When you respect exposure, liquidity, timing, and discipline, you give yourself room to survive and adapt. If this breakdown helped you see investing more clearly, support the channel by liking the video, subscribing, and sharing it with someone who might need this perspective. Leave a comment with your thoughts or experiences. Your insight could protect someone else from a costly mistake. Stay aware, stay disciplined, and stay connected for more clear, honest investing insights.